have a very, very special guest sitting right here with me. He's one of the most sought after traders, I would call it, in India. Hi, Atul.
Hi.
Thanks so much for joining us today on the sidelines of Traders Carnival. I'm going to first talk to you about the current trends that you're, witnessing in the market. What sort of market environment that you're foreseeing for this year? What's the current market prognosis that you have? Do you think we've topped out for 2018, or one can still witness fresh highs? I'm talking about it on a day finally when there is some respite that we've seen some gains coming in the last two trading sessions.
Yeah, no, I think it's a very significant day because one is 10,600 has been an important level, and on the way down, it had found a lot of resistances. So taking out this level is significant. I won't say that we've topped out for the year or that we will not touch fresh highs. I think it's very, very possible. But what I think is that this year, going ahead, we are not going to have a massive move on the index. This index is going to actually wrong foot you. The moment you feel very bullish, the market will correct, and the moment you start feeling bearish, the market's going to go up. So this is a year where it's going to be more about stocks and being stock specific, and this is a year where I think quality is going to reassert itself.
Right.
Very different from what it did last year, and that's the nature of markets, because now markets are cyclical. No trend will last forever.
Right.
So last year we had a very good index move, and more importantly a very big move in small caps and mid caps. But I think this year we will not have a very large index moves. Index will be in a broader range, in range bound, but I think quality will reassert itself, and we are already seeing early trends of that. So I think that will be the trend going ahead.
So would that also mean this could be the year for large caps and not broader markets, because we've seen sharp correction for the mid cap and the small cap index this year?
Yeah, I think large caps, but I think quality, because quality transcends large caps and mid caps.
True.
So I feel that even if you're a large cap but you are not qualitatively good, you're having performances, it's not going to go up just because it's a large cap. Even in mid caps, there are a lot of stocks that have come out with excellent numbers, excellent quality, and I think they will continue to trend and keep making new highs. So I think it's about quality and performance. Last year was a lot of a hope rally. A lot of people thought that this thing will happen and this stock will do well, or these earnings will improve. But I think this year, wherever there's going to be demonstrated earnings, or wherever there's going to be proof of the pudding, that is going to get rewarded and get disproportionately rewarded. And as I said, that already in this correction, we are seeing signs of that.
You know what, last year when there was such a big rally that one saw for Indian markets, there were a lot of new investors, Atul, who entered into equity markets, and most of them, they were putting their money in mid-cap and small-cap index, and now when you interact with them, they're growing. What are you going to tell them?
I mean, absolutely. The reason is because people, while investing with mutual funds, PMSs or AIFs, focus on returns. And that's the wrong way to go. You have to focus on strategy. So 6 months ago, 9 months ago, any investor you met wanted to put money in as a small cap fund or a mid cap fund, or a PMS that are a smaller mid cap strategy. Not because they cared for the strategy, it's just because the returns were so good. So people were chasing returns. And the pain with people who came in late is that they're seeing massive drawdowns. The fault is not the fund managers. The fault is not the strategies. The fault is the fact that if you chase returns, you cannot have a strategy that will outperform on both sides. If you have a small mid-cap strategy, it will do very well in a bull market. And we know historically that when markets correct, the correction here will be larger. So the fact is that investors should focus on strategy. And strategy is a function of their risk profile. So, it's like, as they say, that if spring comes, winter's not far behind. And if winter comes, spring is not far behind. That's the nature of markets. So if you've had that kind of drawdown and you've come in late, I don't think a fund manager or a strategy is to blame. That is the nature of the strategy. Follow a strategy, invest based on a strategy. If that strategy suits your profile, do not follow returns, because returns are very cyclical.
And do you think volatility will continue to be at elevated level for 2018? Because that's been the dominant theme. You talk to any market participant, they said there was no volatility in 2017, but globally now they're saying this will be the year of high volatility.
I think so. I feel so. And at the end of the day, as I said, that we may not make massive outperformance on the upside or downside. So you will see a lot of volatility, but net you will see the index for the year may not be a big plus or a big minus. So the distance the market will travel is a lot, but at the end, the journey it covers will be very little.
Everyone's not a good trader like you, Atul. People who are investing in markets, how should they look at volatility?
So I feel that you have to, the only way, and even as traders, we expect that we can ride volatility. The answer is no. It's a must. It's a very, very difficult phase. Unless until you do not stretch your time frame, your time horizon, it is very difficult to, sort of surpass this. So make sure that your time horizon is large. Even people who are suffering very big losses in small and mid caps who've come in late, the fact is that if they give it time, it will all come back and give them very good returns. The problem is that people splice data. They say from Jan to May, my drawdown is so much. Hey, but go back 2 years and see, you're still up so much. So you cannot be selective. If you're going to play this kind of momentum, then give it some sort of time. The only way to sort of circumvent this volatility is to give it time. Because when markets emerge in the next cycle, all these funds and PMSs will do very well. So first, focus on strategy, and second is focus on long term. If you start taking short-term views and short-term return views, then I guess you're better off playing the derivatives market.
So you need to be a long-term investor to make money.
Yeah, you have to give it 3 years. You have to give it a cycle to sort of, prove itself.
Okay, let's talk about the metrics which are in focus right now. Everyone's talking that macros now are deteriorating. Obviously, US bond yields are on the higher side. Indian bond yields have also surged. We've got crude prices which are inching higher. Rupee is depreciating. I think today we've seen some bit of appreciation coming in for rupee. What are the charts of crude and rupee indicating right now?
So I think for me, in this whole thread, which is very, very complex, I look at the tip, and which is, I think, crude for India, because it has immense impact on the currency and bond yields. And these all things really have a big knockdown effect on markets, stocks and sectors. So I really look at crude. I feel that crude in the short run has run up pretty hard, and it may kind of stabilize to correct, but I think it's going to be short term. Ultimately, I think crude is going to head higher. My target for crude has been $90, but it does not mean that, just because it goes to 90, Indian markets are going to get adversely affected. What's important for the market is the preparation. When unexpected events happen, the markets get surprised, and that's where the hit happens. But if the market starts building in or factoring in these kind of moves, I think the important point is that the market is coming to accept that crude will stay elevated.
You accept that, Atul, but when you look at a country like India, which is importing majority of its crude requirement, there is that fear of fiscal slippage.
Yes, there will be. There's no doubt about it. You're going to have pressures on currency, you're going to have pressures on bond yields, but I don't think it's going to go so out of whack. It's not going to just destabilize the whole thing, or people fear market crashes and all. I don't think that will happen. Yes, market corrections happen. Certain sectors get re-rated, certain sectors get derated, but that's the nature of market. If every time in my life, and will continue in the past and history, future, whatever you say, concerns have to be there. If there are no concerns, you will not have markets.
This also gives you an opportunity
this gives you an opportunity. Portfolio. Absolutely. You will find that, right now what is happening is that the OMCs are getting smashed, and certain IT-related sectors are going up. So if there is fear here, there is greed here. So these things will keep happening in the market. And that's what a money manager's job is, to navigate through these things. So we are surfers, there are waves that will go up and down. Our job is to just surf.
And you like surfing, isn't it?
I like the water, I like the sea, and I very often, tend to sort of draw parallels between that. But I guess it's just a passion.
I'm not going to deviate from markets right now. You mentioned IT, Atul. That's one sector which has bucked the trend for 2018. I'm sure rupee depreciation is creating tailwind for this one. What else, according to you, can buck the trend? Do you think pharma can be a dark horse?
See, I'm a trend follower, so I'm not into picking bottoms. I'm not into finding hidden gems. I'm into actually identifying longer term trends and riding them. So for me, what you pointed out, IT is definitely a space. And what I like about IT is that it's a very large sector in terms of market weightage, and a lot of people have been very underweight. So one is that when you have a sectorial breakout like in IT, and the beauty is when there's under ownership, that actually leads to a very big surge. So I really like IT. The second space, again, may sound very cliched and not too brilliant, is consumption. But I think that consumption is still going to, has a long way to go ahead. Whether it's your FMCG or other related consumption stories, I think is here to stay. And the beauty in both of these sectors you will find is that it is a relatively detached from crude or, etc. and things like that. People are going to consume their biscuits and chocolates and coffees and milk, etc., irrespective of what happens to crude. And similarly, same goes for IT. So I think crude, as I said, is the big story for me for this year. I feel that crude will go higher, but in the short term, it will have a pause. And that pause is being reflected in the market, whether it's today or will be in the short term. So I feel that you want to get away as far away from industries that are dependent on crude as an input.
So 90 is your target for crude. What about rupee?
Rupee, I think, will also, approach its previous high, which was
69 point something. We may be heading in for
but I really don't think it will be a total blowout. People are. I don't think it's going to just like freak out and run away. It will remain calibrated, but then that's the nature of the markets.
Okay. You do track the MSCI emerging market basket very closely. I heard in one of your interviews. I was just checking the returns of MSCI EM. I think that's down 2%. But India has been underperforming. We've seen FI selling. That remains unabated. Do you think this trend will continue? Because 2017 was a year when there was a lot of support which came in from domestic institutions. And that trend continues till now. Do you think it's going to continue till the end of this year?
So if you look at the emerging market basket, there is a lot of concern that this easy liquidity which was there, which is getting squeezed and it is showing in higher US bond yields, will affect the emerging markets. And I think that the pressure may come in. But I find that India very often is a country that's very, very delinked from there, and it has its own strengths and weaknesses. And I feel that in this basket, a lot of emerging markets, countries like Brazil, countries like Russia, are very commodity driven. So they do well in that kind of phase. But India actually is, I think, very, very different. And I don't think that India is going to be such a kind of at the mercy of the whole emerging market basket. Because the fact is that if you see the rally in the Indian markets in the last 1.5, 2 years is more domestic money. FIs have been selling for the last 1.5. I think so. When I meet investors, again, the kind of interest, the kind of participation that there is, and most important is what I call the TINA factor, that there is no alternative factor. The kind of money that's flowing into equity is more a function of very low returns in other asset classes. Whether it's a fixed deposit, post-tax, it doesn't even hedge you against inflation. Real estate, I think, is the biggest area where a lot of HNIs have been overweight for years and maybe generations. And even if a small chunk flows to equity, I think is going to have a very big impact. It's already happening, but I think going ahead, it is sort of going. Unless until we don't have a very big market crash and things like that, But even if markets remain reasonable, you have your 15, 18, 20% kind of yield. You don't have to have something run away also. I feel that there is no reason why this trend would not continue. And in fact, I feel that going ahead, it will get accelerated. You will have phases where people may have concerns and, like a correction, things squeeze in, squeeze out. But the trend per se, the larger term trend, I think is the biggest trend for Indian equities is domestic flows.
All right, that's about the current trends where Atul Suri feels we've not topped out for the year. Probably we could be in for fresher highs. But considering we have him on the sidelines of Traders Carnival, I want your views on technicals, because you're one of a very few person I have met in my life who's first started his career with fundamental analysis. Tell me, when you punch in your trade or when you execute a trade, is it solely based on trends, or you also club it or blend it with fundamentals?
So I'm a trend follower, but I also find that ultimately everyone is looking for trends. Even a fundamental analyst or a technical analyst. What is a fundamental analyst looking for? He's looking for trends in earnings. Ultimately, what is he looking? He's looking for a company that consistently delivers good returns, good numbers. And that is what a technical analyst is doing. So ultimately, we are all looking for a trend. We are all following a trend. I use both mediums, I feel, because both, when they go hand in hand, are much sustainable and bigger trends. If you have some great numbers, but if the prices don't reflect it, it is useless. Sometimes you have price trends, but the earnings don't reflect it, then those are temporary. But whenever you have a price trend and a fundamental trend, I think it tends to be longer and sustainable.
What takes precedence?
I sometimes wear my technical hat, because more so, especially when I have to, exit something. I'm very, very price sensitive, because very often when prices damage happens, it very often precedes something that will follow later on the fundamental area, because markets have their own intelligence, and there's a lot of inner wisdom as far as stocks and markets go. So whenever prices break more than comfort or when the trends break on the price, I tend to not ignore that.
You know what, you talk about technical analysis and two things which strike your mind. One is price and the other is trend. Is there something more to technical analysis that we don't talk about?
No, I really think that most people look at technicals or view technicals as just a 2 rupee stop loss and a 5 rupee target. That's the whole game, and that's thanks to computers. But technicals were never, all these indicators were never discovered in this computer area. They've been going on since few hundred years when people did it on graph paper and by hand. So I tend to be more classical in my way. I look at I love to see things that have lived time, who've been tested over time, over hundreds of years. That is why I tend to be more long-term in my approach, and I view technicals in a very classical way, in a very long-term way. I'm a great lover of the Dow theory. It's as simplistic as it gets, but it's that simple, and I don't go into very esoteric stuff, very complicated stuff, very crunchy stuff. No, that's not an issue.
You call yourself a trader, and you're running a PMS. It's very rare to hear that. Can you talk more?
I'm not, see, a trader is again, and an investor are again relative terms. When you have price, when you look at price, you're a trader. When you look at fundamentals, you're an investor. Is that the right way? What is long-term, short-term? So these are all very, very...
traders are chasing prices and investors are chasing value.
So I chase earnings and I chase price. So I don't understand value.
So what's the time horizon for your PMS? Because when somebody talks about trading the longer term, you can think of a 6 months or maximum 1 year.
I would love to, and I hold stocks for over 5 years.
5 years.
Yeah, so there's nothing wrong. There is something called long-term trend following. There are long-term trends in stocks, in industries, in countries. It's your job to actually sit and identify these trends and have the patience to ride through them. And I feel, through my learning and people I'm associated with or have read about, I feel that's how big wealth is created, and that's what I'm setting out to do, really.
Give me 3 variables you use before executing any trade on basis of technicals.
As I said, I use earnings, so it's not technicals. Okay. I use price, which is very important. And third is volumes, which is again a very classical way. Volume is something which is very little studied or very few people use it, but I sort of look for confirmation in volumes.
Is it safe to assume that for you, positional trading works more than intraday or?
Oh, I mean, I don't know what intraday trading is.
Okay.
I must have done it. I've done it at some stage in my life, but I've stayed. I mean, as I said, I'm at the other end of all that. Intraday is like short in a day. I look at months and years.
If you can share with us any trade that you've held for like 6-7 years.
I mean, I wouldn't like to name stocks because I'm not allowed to do that.
But you do hold your.
Yeah, for sure.
Okay, how do you decide and how do you place your stop loss? Because you talk to many analysts and they're like, okay, 2% lower or 1% higher.
But that even while we are talking, it could happen. So as I said, for me, those are not.
So for long-term trades, Atul, how do you place your stop? Do you actually place stop loss for long-term trades?
I don't call them as stop loss. I call them as exits. And the fact is that you can't have it this 2%, 3% rule. I think it's just some mathematical number which may or may not work. For me, it's a change in price and trend. And as I say, I use the Dow theory. Lower tops, lower bottoms is for me a very big exit area. So it's not about a percentage. It's about, it's very simple, It's when you're climbing steps, even if I blindfold you, if your next step is higher, you're climbing.
Correct.
Right? You're still blindfolded, but the next step you take is lower. You exactly come to know that you're going lower. So that is exactly what the Dow theory is. It's about higher bottoms, higher tops, lower bottoms, lower tops. So for me, a change in trend is when we make a lower bottom, lower top. You can be blindfolded. Just the steps can tell you whether the trend is changing.
One mistake a lot of traders tend to make, and I'm not talking about the experienced traders, people who just get into trading, they start averaging. Do you believe in that theory of averaging?
I don't believe in catching a falling knife. Because after that, it's your toe, it goes into, I pyramid in strength, I exit on weakness. So averaging is definitely not a mantra for me.
Not even for long-term trades?
No, for me, it's pyramiding.
Okay. They say markets, either they teach you a lesson or they make a lot of money for you. What has been your biggest lesson from stock market and trading?
Cutting your losses, cutting your losses, cutting your losses. This market is... we all think and try to be very, very fancy and try to talk about these great trades we have, which are multi-baggers. But let me tell you, a lot of people, talk a lot of whatever, they never hide the story. Your success rate in terms of getting your right trades is much lower than what people project. But the key thing is that when you lose little, and when you make very large. So the objective is to lose little, because sooner or later there's going to be a nice big wave and it's going to take the ships higher. So the fact is that to be able to survive for that long, you have to make sure your losses are small. Sure. A lot of people actually get into this, I am going to be 100% right and all 10 trades are going to be right. That never happens. It is all good luck or an absolute lie.
So any advice you would like to give to a new trader?
I think that be disciplined about cutting losses, because you need to survive to trade another day. This market will give you opportunities. The problem is that most people are unable to cut their losses because their ego gets in, and that is why they get eliminated. And that's when the big trade comes or the big wave comes. They're not there to surf it. You have to wait for the big wave. You can't try to surf every wave or every small rivulet that kind of thing moves in the water. So wait for the big thing. Till then, you may have to pass the smaller stuff. You may have to cut a lot of losses.
In this market.
Market will give you a chance, for sure.
Okay. You talk to a lot of investors. They look up to Warren Buffett. Who does Atul Suri idolize?
So there are three people who really I sort of admire. Warren Buffett, of course, is a great guy. I mean, there's so much to learn about life from him also. So maybe my style may be very different, but I learned so much from him as an individual. Second is a little-known person, Ed Saikota. He's a father of trend following or master of trend following, and that's my trading style. And third is my mentor, Rakesh Jhunjhunwala. He's a great person, and I'm so fortunate that, I've been able to be associated from him, learned from him, and have his good wishes. I have seen the power of compounding work no better than in his case, and that is the biggest lesson in my life that I've learned, and that is thanks to Rakesh ji.
So you're staying close to fundamentals as well.
Of course, I combine the two. At the end of the day, it doesn't matter whether you use fundamentals, technicals, as long as you can work something, and something that works which fits your personality. The biggest trick is to have a methodology that suits your personality, because what suits your personality is something that you'll sustain. Right. Anything that has a conflict with your personality, sooner or later you're going to jump ship.
Atul, my last question. I know you like to spend your money on traveling and indulging in good wine. I want to know what else you like doing. What do you do with your profits?
I would reinvest them. That is power of compounding.
Okay. Nothing else besides traveling or indulging in good wine?
I love coffee also.
That's not too expensive.
But the fact is, for me, my biggest passion is travel. I love traveling. I love scuba diving. I love the ocean. So any opportunity to do that, and that's something I want to tick all the boxes about. But I think the single largest passion for me is travel.
All right, Atul, it was a pleasure talking to you. Thanks so much for giving your time.
Thank you very much. Thanks for having me.